Okay, it's a couple minutes past the top of the hour, so I think we'll go ahead and get started. Hello, and welcome to today's webinar. New for 2026, mandatory Roth catch-up contributions for highly paid participants. Long title, but definitely apt for what we're going to be talking about today. Presented by Union Bank and Trust. Presenting today is, of course, John Nouns. And John is a vice president and an ERISA attorney, as well as a relationship manager here in Retirement Plan Services at UBT. Just a little bit of housekeeping here before we get started. We will leave time at the end for questions. So if you do have any questions, please hang on to those until the end of the webinar. And if you utilize the chat box, we'll definitely get to those questions as well. And John's contact information will be posted at the end of the webinar. And as always, feel free to reach out to your relationship manager with any follow-up questions that you may have. We always think, all of these are extremely important. I think this one, it's even more so than some of the previous webinars that John has done. This information is extremely important. So if you have any questions, please feel free to reach out to your relationship manager. Today's presentation is being recorded and will be included in the quarterly plan sponsor email, as well as posted to the website. And when the recording becomes available, we will send out some information notifying you and letting you know that the presentation is available and then where you can access it. And before I hand it over to John, I'm not going to read this disclaimer verbatim by any means, but we just want you to know that the information that John is going to provide is intended for informational purposes only. Neither John nor UBT is providing any legal, tax, or financial advice. It's just education, and that's what this disclaimer is saying. So with that, I'm going to hand this over to John. So just give me 1 second real quick.
Thank you, Jason, and welcome to the Union Bank and Trust Company webinar about the mandatory Roth catch-up contribution rules for our highly paid participants. We're going to spend most of the time today talking about the IRS proposed regulations that were issued in January of this year with respect to these new rules. But first, I want to start out with, I recognize the difference in experience among our attendees, so I did want to take a couple of minutes and refresh our recollections of some basic concepts of Roth contributions as well as catch-up contributions. At the end of the program, I'm going to provide some action items that you need to take before January 1st of 2026. And then, as Jason said, I'll be glad to answer any questions. And furthermore, to reiterate what Jason said, you can always call me or email me after the program if you prefer with any questions, and my contact information is on the last slide. So with that being said, once upon a time, if I were a participant in my employer's 401k or 403,
it's going to be annoying. I forgot my headphone, my webinar. Okay.
And I wanted
I can pop in the small room.
Deferrals in my retirement plan. Those deferrals had
What'd you say?
Pre-tax. I mean, could everybody make sure that they're muted? We can hear some folks talking in the background. Thank you.
And so beginning in 2006, if you haven't noticed, Roth has been creeping into our retirement plans. First, there were Roth deferrals, and then in-plan Roth rollover contributions. And with Secure 2.0, we now have the ability, if plans permit, to make elections in Roth with respect to our employer contributions. And we also have this new rule that we're going to talk about today. Now, if I were a betting man, and if I were going to Las Vegas, I would bet that we're going to see more Roth provisions added to our plans in the next couple of years. And so the difference between Roth and pre-tax deferrals is the tax benefit on pre-tax deferrals happens when those pre-tax deferrals are finally distributed out of the deferral account. With Roth, it's the exact opposite. The tax benefit the tax benefit for the pre-tax deferrals happens when they're contributed to the pre-tax deferral account. The tax benefits with Roth deferrals happens when there's a distribution from the Roth account. And so, for example, if I've got $50,000 in compensation and I tell my employer, hey, I don't want all $50,000, send $10,000 to my Roth deferral account. I will be taxed on all $50,000 this year, including the $10,000 in Roth deferrals. So I get the benefit on the back end when I finally receive a distribution from my Roth deferral account. And so when I receive a distribution from my Roth account, the Roth deferrals will always be distributed to me on a tax-free basis. And so the only question is whether those earnings on those Roth deferrals will be distributed to me on a tax-free basis. And as long as two conditions are satisfied, then those earnings will be distributed tax-free. The first condition is that the distribution must satisfy the 5-year rule, and the distribution must be made after the participant has attained 59 and a half, or has become disabled, or has died. So a quick example, remember I put $10,000 into my Roth deferral account. I now, several years later, I want to receive a distribution of my Roth deferral account. My Roth deferral account is now $40,000, consisting of $10,000 as Roth deferrals and $30,000 of earnings on those Roth deferrals. I made my first Roth contribution to the plan in 2025. That means that the 5-year rule is satisfied on December 31st, 2029. So as long as I receive a distribution from my Roth deferral account on or after January 1st, 2030, and the distribution is made to me after I have attained age 59 and a half, or I've become disabled, or I have died, then the $30,000 in earnings will not be taxed. If those two conditions are not satisfied, then I'm going to be taxed on the $30,000 in earnings when they're distributed, but the $10,000 in Roth deferrals will be distributed to me on a tax-free basis. Next, catch-up contributions. All of us are familiar with, I'm assuming, that there is an elective deferral limit, the maximum amount of deferrals that a participant can make into the plan for any year. For 2025, that limit is $23,500. But if a participant is age 50 or older, that participant, who we're going to call a catch-up eligible participant, is allowed to make an additional $7,500 in 2025. And beginning this year, we also have an enhanced age 60 to 63 catch-up contribution, and that enhanced catch-up contribution limit is $11,250 in 2025. Now, how about that last bullet point? If your plan allows for this enhanced age 60 to 63 catch-up contribution, what it means is that a participant who's 60, 61, 62, or 63 can go up an additional $11,250. But the year in which that participant attains age 64, they go back to that age catch-up limit. It's almost as if Congress purposely drafted this law so that we'd screw it up when people start turning age 64, but that's the rules. So a key concept of catch-up contributions is that a catch-up contribution only occurs if a limit has been exceeded. So we talked about that 402G deferral limit of $23,500. And if I'm a catch-up eligible participant age 50, I can go $7,500 on top of that $23,500. If I'm ages 60 to 63 and the plan allows for it, I can go an additional $11,250 on top of that for 2025. So we don't know, well, rather, let me go the rest of the slide. The second limit is what I call the 415C all-in limit, which is $70,000 for 2025. So unlike the deferral limit, what we're talking about here is the sum of all the contributions that are made to the participant's account in any year. So what we're looking at is total deferrals, regular matching and non-elective profit-sharing contributions, any safe harbor matching contributions, any safe harbor non-elective contributions. All of those contributions combined can't exceed $70,000. Again, though, our catch-up eligible participant can go above that $70,000, either $7,500 or $11,250. Next, there's I don't know if we have any plans with it, but some plans have plan-imposed limits. So, for example, an employer might say, if you're a highly compensated employee, you can only defer up to 10% of your compensation. So if I have $200,000 in compensation, I can only defer up to $20,000, 10% of my compensation. But if I'm catch-up eligible, I can stack on another $7,500 or $11,250 on top of that to $20,000 that has been imposed on me by the plan. And then finally is the ADP limit. So if your plan is not a safe harbor plan, then you need to conduct on an annual basis the ADP 401k non-discrimination test. And what this test looks at is the deferral percentages for your highly compensated employees compared with the deferral percentages for your non-highly compensated employees. And if the deferral percentage of your highly compensated employees is too much compared with the deferral percentage of your non-highly compensated employees, we fail the ADP test and we need to correct it. And typically, how this test is corrected is if our highly compensated employees haven't attained age 50, we refund the deferrals or partial deferrals to our highly compensated employee. If our highly compensated employee is catch-up eligible, in other words, at least 50 years old, the plan will reclassify a portion of the highly compensated employee's deferrals as a catch-up contribution in an amount needed to pass the ADP test. So with that, let's get to the main topic of our discussion today, and it's Secure 2.0 was enacted in late December 2022. And what Secure 2.0 said is that beginning in 2024, Secure 2.0 would have required catch-up contributions be made on a Roth basis for any participants that have FICA wages that exceeds $145,000 to be adjusted for inflation for the preceding year. And we're going to call them highly paid participants. And that applies to the age 50 catch-up or the enhanced age 60 to 63 catch-up. So that was beginning in 2024. Thankfully, the IRS delayed those provisions until 2026, and that's why we're talking about these new rules today. These rules apply to 401k, 403b, and governmental 457b plans. Now, a couple of unusual points about these new rules. The first is we're only looking at FICA wages. We don't care about self-employment income. So if you're a sole proprietor, if you're an LLC member, if you're a partner in a partnership, and all you have is self-employment income, you don't care about these rules. We're only looking at FICA wages. So when this law was passed, we were told that this was a mistake by Congress. They did not intend to carve out self-employed workers from these new rules. But here we are sitting in August 2025. We don't have any technical corrections. So we take the rules as we find them, which means that folks with self-employment income above the $145,000, if they are going to make catch-up contributions, they can make those catch-up contributions on a pre-tax or a Roth basis. They're not required to make catch-up contributions on a Roth basis. We only care about FICA wages. The second thing is, again, it looks like a purposely laid trap by Congress. We're not talking about highly compensated employees. They could have simply said this law is going to apply to highly compensated employees because we work with highly compensated employees every year. We know who our highly compensated employees are. No, these are highly paid participants, and that's a term that I made up. The regulations of the statute only talks about these folks as employees with FICA wages that exceeds $145,000. So if you're reading articles or attending other webinars, these folks may be referred to as highly paid individuals, highly paid employees, high earners, high wage earners. I'm going to call these folks highly paid participants for purposes of our presentation today. So As I said, all we care about are FICA wages. We don't care about self-employment income. And interesting is that 145,000 plus in FICA wages must come from the employer sponsoring the plan. And so we're going to give a couple of examples to illustrate these first two bullet points. The other thing that you should realize is that, so what we're trying to do is, for example, we need to find out who our catch-up eligible participants are in 2026. And then what we need to do is look at their 2025 FICA wages. If their FICA wages exceeds $145,000 in 2025, they're a highly paid participant in 2026, meaning if they make catch-up contributions in 2026, those catch-up contributions need to be made on a Roth basis. Now, we don't know yet what the limit is for 2025. We probably won't know until October or November of this year whether that $145,000 limit is going to get bumped up to $150,000. So, for purposes of the examples, I'm going to assume it's going to stay at $145,000 for this year, and our deferral limits and catch-up limits in 2026 are also going to be the same as the 2025 limits, keeping in mind that they could very well be adjusted for inflation. So let's look at this example. We've got a catch-up eligible participant who works for a law firm. Our participant has $125,000 in FICA wages from January 1st, 2025 through June 30th, 2025. Our participant becomes a partner at the firm on July 1st and has $125,000 of self-employment income from July 1st, 2025 through December 31st, 2025. This participant, this catch-up eligible participant, is not a highly paid participant in 2026 because our participant only had $125,000 in FICA wages in 2025. We don't combine the $125,000 in FICA wages with the $125,000 in self-employment income. This participant is not a highly paid participant for 2026, meaning that if our participant wants to make catch-up contributions in 2026, our participant can do so on a pre-tax or a Roth basis. And in fact, if this participant never again has FICA wages from the law firm, then the participant will never be a highly paid participant unless and until Congress passes a technical correction to apply these mandatory Roth catch-up contribution rules to self-employed workers. Next example, we've got a catch-up eligible employee with FICA wages of $500,000 at first employer in 2025. Our employee terminates employment with first employer on December 31st, 2025, turns around, starts working for second employer on January 1st, 2026, and starts participating in second employer's 401k plan on January 1st, 2026. Employee is not a highly paid participant in 2026 for purposes of second employer's 401k plan because those FICA wages were not earned with respect to second employer. Those FICA wages, yes, are exceeding $145,000, but were earned while working for first employer. So in 2026, our employee can make their catch-up contributions on either a pre-tax basis or a Roth basis, their choice with respect to second employer's 401k plan. Now, interestingly enough, if our employee doesn't like the work at second employer and goes back to first employer in 2026, that employee would now be a highly paid participant in the first employer's plan because our catch-up eligible participant had more than $145,000 of FICA wages in 2025 while working for first employer. Another example here, we've got first corporation and second corporation are members of a controlled group of businesses, they're related employers, and they are both participating employers in the same 401k plan. If we stop right here, for the qualified plan rules, related employers are treated as a single employer for qualified plan purposes, but not for these mandatory Roth catch-up contribution rules. We're not going to aggregate the FICA wages of $125,000 earned for first corporation with the $125,000 of FICA wages with second corporation. Although we have a total of $250,000 in FICA wages, we don't have more than $145,000 with either of these companies in the 401k plan. So our participant is not a highly paid participant, and our participant for 2026 can make Roth, or rather make catch-up contributions either on a pre-tax basis or a Roth basis. So the question has been asked and answered by the proposed regulations is, do we need a Roth feature in our plan? What if the plan doesn't allow for Roth deferrals? And I think we might have a couple of plans that still haven't adopted the Roth deferral for features. So if your plan does not allow for Roth deferrals, then your highly paid participants can't make catch-up contributions. Because if you have a highly paid participant and that highly paid participant wants to make catch-up contributions, it has to do so on a Roth basis, but the plan doesn't allow for Roth. So that means that only your non-highly paid participants will be able to make catch-up contributions in this plan that doesn't allow for Roth deferrals. It is my belief that, and not everybody wants to make Roth deferrals into a plan, but it is my belief that a significant number of highly paid participants, if you were to give them the choice of making no catch-up contributions to the plan or making Roth catch-up contributions to the plan, I'm going to assume that a significant number of your highly paid participants, even though they would prefer to make pre-tax deferrals, or rather pre-tax catch-up contributions, they would rather have catch-up contributions made on a Roth basis rather than not make any catch-up contributions to the plan. So if you do not have a Roth deferral feature in your plan yet, and you want to give your highly paid participants the opportunity to make catch-up contributions to the plan, you're going to need to amend your plan no later than December 31st of 2025 to permit Roth deferrals in your plan. Now, the IRS proposed regulations provided a few helpful provisions that will help us comply with these new rules. And one of these helpful provisions is this concept of the deemed Roth catch-up contribution election. So we can have our plan provide that a highly paid participant is deemed to have designated any catch-up contributions as Roth catch-up contributions. So for example, even if we have a highly paid participant who says, I want all of my deferrals to be made in pre-tax, if we implement this deemed Roth catch-up contribution election, then any catch-up contributions will automatically be treated as Roth catch-up contributions without any additional action on behalf of the highly paid participant. But the regulations tell us that we must give our highly paid participants an effective opportunity to opt out of these deemed Roth catch-up contribution provisions. The regulations do not tell us how to implement the deemed Roth catch-up contribution elections or how we give the highly paid participant an opportunity to opt out of the deemed Roth catch-up contribution provisions. I think the most natural way to do it is to draft a revised salary reduction agreement that explains these rules to our highly paid participants, and we give them kind of a check the box election that says, I don't want to have deemed Roth catch-up contributions made to the plan, which essentially means they won't be able to make catch-up contributions to the plan, and that's fine. But I think we're going to deal with this deemed Roth election and the opt-out provision through a revised salary reduction agreement for a highly paid participant. And we'll see through a couple of examples that this really is a very helpful provision because it allows for administrative simplicity as well as it's going to provide us flexibility when we have errors with respect to these new provisions. So here's an example. We've got a 50-year-old catch-up eligible participant who's a highly paid participant and a highly compensated employee. Keep in mind, we can't have highly paid participants who are not highly compensated employees. But here for this example, the person is both a highly paid participant, subject to these new rules, and a highly compensated employee. Our participant makes $20,000 in pre-tax deferrals to the plan in 2027, well below our $23,500 deferral limit for 2025, but we have to refund or classify this $5,000 to our highly paid participant / HCE because our plan fails the ADP test. If our plan does not allow for Roth, then the only way to correct this failure is to distribute that $5,000 in excess contribution. So if your highly paid participant would have preferred to make catch-up contributions on a Roth basis rather than make any catch-up contributions, this defeats the purpose because our plan does not allow for Roth. Now let's assume our plan does allow for Roth and we have implemented the deemed Roth catch-up contribution election for our highly paid participants. In this case, we're going to assume that our highly paid participant did not elect out of the deemed Roth catch-up contribution election. So at this point, without any additional action on the highly paid participant's behalf, the plan can automatically reclassify those $5,000 in pre-tax deferrals. We're going to reclassify them as Roth deferrals through an in-plan Roth conversion as long as in-plan Roth rollovers are allowed, and we're going to talk about that in a couple of minutes. So if there is no Roth election, in other words, a highly paid participant says, I want it all pre-tax and has elected out of the deemed Roth catch-up contribution limit, then reclassification to Roth won't be allowed. We're going to have to distribute that $5,000 in excess contribution. Another helpful provision is that the plan can treat pre-catch-up Roth deferrals as Roth catch-up contributions. So here's how this works. We've got a highly paid participant who makes $18,000 of Roth deferrals, $2,000 a month for the first 9 months of the year. Our highly paid participant jacks up their deferrals to $3,000 a month, so makes $9,000 of pre-tax deferrals from October 1, 26 through December 31st, 2026. So remember what I said earlier, a key concept of catch-up contributions is we don't have a catch-up contribution until a specific limit is triggered. And it's only that next dollar above that limit, which we've triggered, will be a catch-up contribution. So we cross over the $23,500 402G deferral limit sometime in November 2026, and all deferrals after that are pre-tax deferrals, so we should be in violation of these rules. But no, what the proposed regulations say is, wait a minute, we're going to let you treat pre-catch-up Roth deferrals. In this example, those $18,000 of Roth deferrals contributed to the plan January through September 2026. We're going to let you treat them as Roth catch-up contributions. So in this case, we're okay with the rules. And so we've got $27,000 total contributions, subtracting the $23,500 deferral limit. we've got $3,500 of catch-up contributions, and they're going to be Roth, so life is good in this example. Now, these are new rules for all of us. It's new to participants. It's new to employers, payroll providers, and retirement plan service providers. And so I suspect for at least the first couple of years, there's going to be a lot of errors that we're going to need to be correcting. And so here's the issue, right? Is we've got a highly paid participant who makes catch-up contributions on a pre-tax basis. That's not allowed. Catch-up contributions for our highly paid participants need to be made on a Roth basis. The regulations give us 3 correction methods. The first correction method, and we're going to go into detail about these correction methods. The first correction method is a W-2 correction method. The second correction method is the in-plan Roth rollover correction, the contribution correction method. Sometimes I'm going to call it the 1099-R correction method. And then finally, the distribution correction method. I have heard people call the distribution correction method as the correction method of last resort. So again, we're going to assume that a significant number of your highly paid participants, if they were given a choice, do you want to have no catch-up contributions made to the plan, or do you want to have Roth catch-up contributions made to the plan? You can't do pre-tax. I'm going to assume that a significant number of your catch-up eligible participants are going to say, yep, I would rather do Roth than not do any at all. And so what these first 2 correction methods, the W-2 and 1099-R correction methods do, it ensures that our highly paid participant will be able to make Roth catch-up contributions. That distribution correction method, the method of last resort, means our highly paid participant is going to receive a distribution, and that's how we're going to correct the error. So the W-2 correction method, if our pre-tax deferrals exceed the 402G deferral limit or our 415 all-in limit, and we want to use the W-2 correction method, we need to adopt practices and procedures designed to comply with these mandatory Roth catch-up contribution rules. We need to adopt those practices and procedures before January 1st, 2026. We also need to adopt deemed Roth catch-up contribution election features before January 1st, 2026. So those are preconditions to allowing us to use the W-2 correction method. Finally, we have a pretty tight deadline when we're going to use the W-2 correction method. And our deadline is the correction must happen before the W-2 is filed with the IRS or is issued to the highly paid participant. So effectively, we've got a January 31st deadline to use the W-2 correction method. Now, I think this can make sense if our violation has to do with the 402G deferral limit. But if we're talking about a 415 limit or the ADP limit has been exceeded, we're not going to know if those limits have been exceeded till after the January 31st deadline. So the mechanics of the W-2 correction method is, first of all, we'll jump to the bottom, is that the employer is going to issue a W-2 with a revised box 1 showing that the catch-up amount, the catch-up contribution that was made on a pre-tax basis was actually made on a Roth basis, thus increasing the highly paid participants' taxable income as reflected on box 1 of the W-2. Our employer is not going to include earnings on those Roth deferrals in box 1 of W-2. So that's how this correction is going to be reported to the IRS and to the catch-up eligible participant. At the plan level, what's going to happen is we are going to move those pre-tax catch-up contributions adjusted for gains and losses from the highly paid participants' pre-tax deferral account to the participant's Roth deferral account. Now, this is not an in-plan Roth rollover. Yes, we're moving pre-tax catch-up contributions to a Roth account, but the reporting of this correction is happening outside of the plan. So we're taking care of the tax issues through that W-2. So this is not an in-plan Roth rollover. So here's an example. $23,500 is our deferral limit. $7,500 is our age 50 catch-up limit. Our plan has Roth. Our plan has the deemed Roth catch-up contribution election feature in place, and we've adopted our practices and procedures before January 1st, 2026. Our highly paid participant makes $31,000 in pre-tax deferrals in 2026. All of those $31,000 are pre-tax, including the $7,500 in catch-up contributions that were made improperly on a pre-tax basis. The earnings on the $7,500 catch-up amount is $500. First, reporting. We're going to, if we satisfy and we meet our January 31st deadline, we're going to correct this failure by using the W-2 correction method. And so we're going to put in the W-2 box 1, we're going to have an additional $7,500 of Roth deferrals originally made pre-tax, but we've recharacterized as Roth. And that $7,500 will be included in the highly paid participants' 2026 taxable wages. We're not going to report on the W-2 the $500 in earnings on those catch-up contributions. Then at the plan level, what we're going to do is move $8,000. That's the $7,500 in the pre-tax catch-up contributions plus the $500 earnings thereon from the highly paid participants' pre-tax deferral account to the highly paid participants' Roth deferral account. We also can correct failures using the in-plan Roth rollover correction method. Again, I might call it the 1099-R correction method. If we have a failure due to the triggering of the 402G deferral limit or the 415 all-in limit, we need to adopt practices and procedures before January 1st, 2026. We need to adopt deemed Roth election features before January 1st, 2026. And we need to make sure our plan allows for in-plan Roth rollover contributions. If we don't currently allow for in-plan Roth rollover contributions, we're going to need to amend our plan before January 1st, 2026 to allow in-plan Roth rollover contributions for all purposes, not just for purposes of correcting these errors. And we need to adopt that amendment before January 1st, 2026. And we have specific correction deadlines if we're going to use the 1099-R correction method. And our deadline depends on which type of limit is being exceeded. So, for example, if our catch-up contributions exceed the 402 deferral limit, our correction deadline is April 15th of the year following the year in which the pre-tax catch-up contribution was made. And we're used to that kind of correction because we've always had 402G deferral limit issues. If we're dealing with catch-up contributions that exceeds the 415 all-in limit, our correction deadline for purposes of using the 1099-R correction method is 30 days after the deadline for filing our Form 5500, including extensions. And then finally, if our catch-up contributions we've triggered an ADP 401k non-discrimination testing limit or a plan imposed limit. Our deadline for using the 1099-R correction method is 2.5 months following the close of the plan year. That is extended to 6 months following the close of the plan year if we have a qualifying eligible automatic contribution arrangement that covers all employees. So the mechanics here at the reporting level is that we're going to issue from the plan a 1099-R for the year of the in-plan Roth rollover. Again, reminder, if you don't have in-plan Roth rollover contribution features in your plan yet, amend your plan before January 1st, 2026, if you want to take advantage of this 1099-R correction method. So reporting to the IRS, reporting to the participant is going to be done from the plan through issuance of the 1099-R. And then what we're going to do, similar to the W-2 correction method, we're going to move the catch-up amount plus earnings from the highly paid participants Roth deferral account to the highly paid participants pre-tax account to the highly paid participants Roth deferral account, and that's going to be an in-plan Roth rollover contribution. So here's our example, same facts as we used for our W-2 correction method. And so let's jump to the bottom. We're going to correct that failure by reporting it on a 1099-R. So we're going to issue to the highly paid participant and the IRS a 1099-R for 2027 to reflect that our $8,000, remember, that's the $7,500 of improper pre-tax catch-up contributions, plus our $500 earnings on those improper pre-tax catch-up contributions, that we're going to, our 1099-R is going to reflect that $8,000 was converted from the highly paid participants pre-tax deferral account to the highly paid participants Roth deferral account, and that $8,000 will be taxed to our highly paid participant in 2027. At the plan level, the plan is going to initiate an in-plan Roth rollover of $8,000, and that's again our $7,500 of catch-up plus $500 earnings thereon. We're going to move it from the highly paid participants pre-tax deferral account to our highly paid participants Roth deferral account. So same thing is happening at the plan level in both the W-2 and the 1099-R correction methods. But the difference is we're going to report the correction differently. We're going to report it on the W-2 for the W-2 correction method, or we're going to report it on the 1099-R if we're doing an in-plan Roth rollover correction. So our correction method of last resort, we need to make a distribution to our highly paid participant who might not be happy. We're going to have to correct it through a distribution if we missed both the W-2 and the 1099-R distribution, or rather our 1099-R correction method. So we missed those deadlines that we talked about. We're going to need to correct by making a distribution to a highly paid participant. If we don't have practices and procedures in place, we're going to need to use a distribution correction method. If we have adopted the deemed Roth catch-up contribution feature, but our highly paid participant makes pre-tax deferrals and has elected out of the deemed Roth catch-up contribution feature, we're going to need to distribute to correct. If our plan does not adopt deemed Roth catch-up contribution features and our highly paid participant only makes pre-tax catch-up contributions, again, the only way we can correct this problem is by making a distribution to our highly paid participant. So With that, let's talk about what we need to do between now and January 1st. First thing you need to do is talk to your payroll provider and put together a game plan to identify your highly paid participants for purposes of these mandatory Roth catch-up contribution rules. So again, a highly paid participant is someone who is going to be 50 years or older in 2026. They're a catch-up eligible participant and they have FICA wages that exceeds $145,000, maybe $150,000. We'll find out later this year in 2025. If we've got a catch-up eligible participant who doesn't have FICA wages that exceeds $145,000, we don't care. They can do catch up on a pre-tax or a Roth basis. But we're going to need to identify highly paid participants, and we're going to need to do that on an annual basis. Next is talk to your payroll provider. What about the ability to shut off your highly paid participants at the 402G limit if our highly paid participant doesn't have a Roth catch-up election in place? So in other words, our highly paid participant says, I want all pre-tax. We're going to have to shut them off. If they don't have a Roth deferral election in place or a deemed Roth election, they're going to have to be shut off. How about the situation about can we shut off the highly paid participant at the 402G limit, or rather, I'm sorry, if we don't shut them off at the 402G limit, can our payroll provider timely prepare W-2s before January 31st for those highly paid participants who improperly made pre-tax catch-up contributions that we're going to recharacterize as Roth catch-up contributions, and we're going to reflect that correction on the W-2 before the W-2 has been filed with the IRS or issued to our participants. So our example here, our age 50 highly paid participant elects pre-tax deferrals, but we have a deemed Roth election in place. So the first 23,500 were okay, they can be on pre-tax, but the $7,500 pre-tax catch-up is not allowed. And yet we've got that deemed Roth deferral catch-up contribution election in place. So at the plan level, we're going to move that $7,500 of pre-tax catch-up to the Roth account. And we want to make sure that our payroll provider, if we're going to use this W-2 correction method, that our payroll provider can put out a W-2 with box 1 showing that those $7,500 that went into the plan as pre-tax initially is actually going to be treated as Roth catch-up deferrals. If our plan doesn't allow for Roth deferrals, we're going to need to shut off our highly paid participants' deferrals at the 402G deferral limit. If our plan does allow for Roth deferrals, then we should shut off our highly paid participants' deferrals unless the highly paid participant has elected to make Roth catch-up contributions. Then we're good. We don't have to shut them off. If our highly paid participant has previously made Roth deferrals earlier in the year that exceeds the 402G deferral limit, we don't have to shut our highly paid participant off. Remember, that's our example of our highly paid participant starting the year off with Roth deferrals and then moving to pre-tax deferrals, but we're able to use the pre-catch-up Roth deferrals as our catch-up contributions. And if we have a deemed Roth catch-up contribution election in place that applies to the highly paid participant, and our highly paid participant did not opt out of those deemed Roth catch-up contribution elections, then we're okay. That's a lot of work with payroll provider. At the plan level, if your plan does not allow for Roth deferrals today, and you want your highly paid participants to be able to make catch-up contributions, they need to be made on a Roth basis. So if your plan doesn't allow Roth deferrals today, you need to amend your plan no later than December 31st, 2025 to permit Roth deferrals. If you don't, your highly paid participants won't be able to make catch-up contributions to the plan beginning in 2026. Also, if you want to take advantage of that 1099-R correction method, that in-plan Roth rollover contribution correction method, if you don't have in-plan Roth rollovers in your plan today, and you want to, again, take advantage of that 1099-R correction method, which will be especially useful when you have 415 or ADP limit issues, because these limits are typically only identified after the W-2 correction method deadline has passed. So if you want to be able to take advantage of the 1099-R correction method and you don't allow for in-plan Roth rollovers today, you're going to need to amend your plan no later than December 31st, 2025 to permit in-plan Roth rollovers. If you don't, and the W-2 correction method is blown, then the only way you're going to be able to correct is by distributing catch-up contributions that were improperly made on a pre-tax basis. Finally, you're going to need to implement deemed Roth catch-up contribution election feature no later than December 31st, 2025, if you want to take advantage of the W-2 and the 1099-R correction methods. Again, the regulations don't tell us how to implement the deemed Roth catch-up contribution feature, and the proposed regulations don't tell us how to allow the highly paid participant to elect out of the deemed Roth catch-up contribution feature. So we're going to do that through revising the salary reduction agreement for highly paid participants. At this time, this interaction between the deemed Roth election contribution feature and the opting out of the deemed Roth election feature is not going to be able to be done online. We're going to need to implement that feature and the opt out of that feature through paper. Next, again, if you want to use the W-2 and or the in-plan Roth rollover correction methods, again, not to distribute these catch-up contributions to our participants, you're going to need to adopt practices and procedures no later than December 31st of 2025. And then finally, we're going to need to notify our affected participants. We're going to need to identify who our highly paid participants are in 2026 and explain these mandatory Roth catch-up contribution rules to them and the action that our highly paid participants need to take to get around or comply with these rules. And then finally, we're going to need to put a revised salary reduction agreement into their hands. So from Union Bank's part, what we're going to do is no later than the very first part of October is we're going to put into your hands the documents, that revised salary reduction agreement that can be provided to highly paid participants. We're going to provide you with a practices and procedures document that allows you to use the W-2 and in-plan Roth rollover contribution correction methods rather. and we're going to give you communications that you can provide to your highly paid participants. Again, look for that no later than the very beginning of October of this year, keeping in mind that you're going to have to identify who your highly paid participants are and make sure they get the communication piece sufficiently ahead of January 1st, 2026, so they can elect out of that deemed Roth catch-up contribution election feature. Now, again, you don't need to do this if you're going to design your plan in a way that your highly paid participants just can't make catch-up contributions. But if you want your highly paid participants to be able to make catch-up contributions, albeit they're going to need to be made on a Roth basis, you're going to have to have these deemed Roth catch-up contribution features and the practices and procedures in place to be able to use that W-2 and or the 1099-R correction method. So that's all I've got. I'm willing to entertain any questions. Again, if you prefer, you can always contact me after the presentation by calling me or emailing me.
Yeah, John, it looks like we have one chat question. How do employer match amounts on the catch-up contributions need to be handled? Are these still in the pre-tax bucket?
The answer is yes. Right, is that our employer match was made on a pre-tax basis, and it doesn't matter whether I make deferrals on a pre-tax or a Roth basis. Our match is going to be going into the pre-tax bucket. So even if we have to move some pre-tax catch-up contributions to a Roth bucket, our employer match is going to stay in that pre-tax bucket.
Next question is, what are your thoughts on amending the plan to allow any catch-up contribution?
Or not to allow.
Not to allow any catch-up.
Yeah, you don't have to allow catch-ups. You got to do it across the board. And my experience is your higher paid folks, whether they're highly paid participants or HCEs, may not be too happy about that. But yeah, there's no rule that says you have to allow for catch-up contributions.
And this looks like it's a question about identifying highly paid participants. We have several employees that are commission-based employees, so we won't know if they reach the 145K limit until year end.
Yeah, I mean, that's part of the problem with these rules, right? Is that you're going to have to do the best you can to identify these people as soon as possible before that pay date in 2026. What you can do is, if you've got several people that are kind of on the line, what you can do is say, look, I'm going to play it conservatively and put in their hands that new revised salary reduction agreement that basically says, if I am a highly paid participant, then I understand that if I want to make catch-up contributions to the plan, they need to be done in Roth. So I would recommend putting that revised salary reduction agreement in the hands of anybody who you think may be a highly paid participant, keeping in mind we don't really get to catch-up contributions until later in the year when we trigger some limit. So that's how I would handle that situation.
And that looks to be the end of the chat questions. Does anybody else have any other questions? You can unmute yourself and ask at this point. Okay, doesn't look like it. Thank you all for joining. Unless, John, you have anything else to add?
No, other than that, I'm available to answer any questions by just calling me or emailing me. Again, on the last slide, I have my contact information. So appreciate everybody attending. Thanks.
Thanks, guys. Just to answer this question, did you record this session to send out? Yes, this is being recorded. We will send out a notification to everybody when it is available and where to find it. Oh, we have another question. that just came through here, what if they are making catch-up contributions to both pre-tax and Roth?
Yeah, I mean, and that, I think that kind of goes back to, well, so let's say, for example, if our catch-up limit is $7,500, and if they make at least $7,500 in Roth deferrals at any time in the year, then we're good. Life is good. But let's say we've got pre-tax deferrals and Roth, and we've got $5,000 in pre-tax catch-up and only $2,500 in Roth catch-up, then we're bad with respect to the $2,500 in Roth catch-up, unless we have that deemed Roth election feature. So.
Okay, so we have another question. Is recommendation to have deemed Roth election one time and stands until revoked? Or does it have to be completed each year?
Yeah, the regulations are not clear, but I think the standard rules with respect to deferral elections would come into play here. And so I intend on drafting these agreement elections to stand until they elect out. Now, I think what I would recommend doing is letting your highly paid participants know each year kind of what's going on. But yes, you can have that standing deemed Roth election in place forever until they opt out.
Perfect. Any other questions that you guys might have? I don't want to cut anybody off. Okay. So that looks to be the end. Again, as John said, we appreciate everybody joining today. And if you have any questions, just reach out. Thanks, everybody.